Last Friday, we saw the stock market here in the U.S. really take a tumble. Then we had this nice winning streak, and here we are indicated towards a lower open. What do you make of the action?
I think last week, basically, the headlines of Corona really hurt markets, and I think there's been a bit of a reassessment. So you've seen oil prices, you've seen copper prices hit really hard. The Chinese economy is going to take a hard hit. Retail sales in China will take a hard hit. But I think the market's sort of reassessed the overall developed market economic outlook, and most likely we're not going to have a significant impact if coronavirus stays contained around similar levels to where it is today. So I think the path of least resistance is higher. We've had a bit more central bank easing from China. Accommodative policy all across the globe is going to continue, and there still is economic growth. So our view is that the market maybe overreacted a bit on Friday. It's a complete wild card, so no one knows, but we've not really changed our global equity positioning around Corona yet.
So obviously we've got a long way to go until November of 2020 when we're thinking about this U.S. election. But we are starting to get these early results from primaries. Of course, the Iowa caucus we know was a bit of a mess from a technological standpoint with actually tabulating those results. But is any of that figuring into investor calculus as maybe we're getting a little bit more clarity into what the American public might be thinking about the Democratic frontrunner, if there is one?
Maybe there's a little bit, but I wouldn't be drawing too many conclusions at this point. Very early stages. After we get past Super Tuesday, we'll know a little bit more. Democratic candidates, it looks like Bernie Sanders, Buttigieg, Biden and Warren still all in with a shout. I think market's probably a bit worried about Bernie Sanders. Elizabeth Warren more on the leftist side of things. We're actually buyers of healthcare stocks over the last 9 months, and we think rhetoric will be stronger than real policy change with the Republican-controlled Senate. Most likely, we're going to continue with that. We don't think there's going to be the extreme reforms that are really going to destroy the earnings outlook for healthcare companies. I still think that's a growth sector trading at reasonable multiples. So I wouldn't be drawing any conclusions on the U.S. election because there's going to be a lot of twists and turns, though, before we get there.
Okay, so healthcare is one name potentially, and a still very clouded outlook going forward for the U.S. election. What are other areas that you're interested in right now? We've been talking a lot about energy and how it's kind of an out-of-favor sector in general for many investors for ESG reasons and potentially because global economic growth looks like it's slowing. What do you make of some winners for your portfolio if energy isn't one of them? Or maybe it is.
We've been selling our energy companies. So we've been buying Vestas Wind this year. We've been buying Nesta. They're both in the ESG bracket. So Vestas Wind does wind turbines. Growth is 40% higher than last year. So these environmental companies are benefiting on the top line and the bottom line from increased demand, but I think the stock prices, just as importantly, are benefiting from a Greta premium, basically. The companies that have ESG foundations are seeing increased investor demand from pension funds, retail investors, endowments. Investors really want to have that ESG backing right now. It's a big theme. So these are companies that are growing. They're not cheap by any means. They're trading in the high 20 times earnings, but we think the favorable tailwind in terms of revenues as well as investor demand are going to power these ahead versus an oil and gas sector that you get a high dividend yield, but it's hard to see much upside.
When it comes to perhaps some kind of hedging in your portfolio, what do you think is the best way to play it right now? Or do you think that's not really a smart strategy because equities have been so strong?
I think it's always prudent to hedge. It's always prudent to be diversified. Our preferred safe haven is gold. In our multi-asset portfolios, we have 6 to 7% in gold. This year, we've actually been buying platinum, though. We've got about a 1% weight in platinum, and that's a play on the precious metals linked to gold, but it's also palladium prices have hit $2,300 an ounce. Platinum's still below $1,000 an ounce, and auto companies have said in the past break-even price to transition catalytic converters from palladium to platinum is about $500 an ounce. We're looking at $1,400 an ounce right now. So there's a lot of inertia in production of autos, but there will be a shift away from palladium into platinum at some point. We think that might be a good precious metal that's not as good a safe haven as gold, but it may have some industrial upside going forward.